All right, let's look at the issue of common stock. So this is the other major source of financing for a corporation, and they're trying to raise large sums of money. When you hear about the term IPO, initial public offering, we're talking about initial shares or shares being initially offered to the marketplace, to the stock market, to raise large sums of money. So the firm is going to be interested in the cash amount that's received, and that's always the number of shares times the actual market price. Now sometimes they have a negotiated price with the investment bank that may have underwritten the issue, but essentially there is some price to the share, and that is the amount that the firm that's raising this money, that's what they're going to receive. Now, they're going to record that cash, but then they also have to record a credit to common stock, right, the equity account. And the credit to common stock is always based on the number of shares times the par or the stated value. And if it's no par stock, then you credit the common stock amount for the same amount that you debited cash for the amount of money that was received. So let's look at an example. What if we issued for the very first time 1,000 shares, it's $1 par value, and the market price is $50? How are we going to record that? Well, there's going to be three components to the entry. First, we're going to debit cash because we have 1,000 shares and the market price is $50, so we're going to get cash for $50,000. Then we're going to credit common stock for the 1,000 shares at the $1 par or stated value, par value of $1, so it's a credit to common stock for $1,000. Then we're going to credit additional paid-in capital CS common stock for the difference. So this extra amount above the par value that was contributed by the investors, right, the shareholders, we're going to credit it for $49,000. Essentially, it's a plug. It's an amount to make the entry balance. Let's look at a different example. What if the 1,000 shares had no par value, no par or stated value, and it was still the $50 price? What would the journal entry look like for this transaction? Well, we would debit cash for the $50,000, same thing, right? 1,000 shares times the $50 price, and then we would just simply credit common stock for $50. Now, sometimes we issue common stock for assets other than cash. This is particularly true when it's a small company, privately held, not traded on a stock exchange. Sometimes there's another asset that the company needs, and maybe even more than cash. So in that case, you use the fair market value or the appraised value for the assets received. And then you multiply the par value times the number of shares, and that's going to affect common stock, and then you plug the difference to additional paid-in capital. So let's look at an example. What if we received land, and the land has an appraised value of $50,000, and we got that in exchange for 2,000 shares of 50-cent par value common stock? How would we record the entry? Well, instead of debiting land, we're going to debit land. Instead of debiting cash, we are going to debit land for $50,000. We're going to credit common stock for the 2,000 shares times the 50 cents par value, which is $1,000, and then we're going to plug the difference to additional paid-in capital for common stock. And that's just some of the basics of entries with common stock for cash or common stock for other assets.